All right, chapter 14, we're going to look at mutual funds, we're going to look at real estate, and other choices in which you could invest. So we're continuing to talk about investments. So a mutual fund, mentioned in the previous video, it's a professionally managed group of investments using a pool of money from many investors. So in a mutual fund, you are one investor among many that pull your money together and have a fund manager who uses that money to buy stocks, bonds, and other securities. And the kinds of securities that they buy depend on the stated investment objectives. So let's say you have a mutual fund that you want to get a long-term yield for your retirement. The types of funds that your fund manager is going to invest in will be lower risk, but steady, safe investments that over the course of 30 or 40 years are going to yield a predictable result. So that fund manager is going to buy and sell stocks at different times with that in mind. Let's say you have a mutual fund that is maybe more of a short range, trying to make as much money as possible. So your fund manager is going to put things into higher risk, but higher yield investments that you could revisit in a few years and pull your money out of and potentially make a lot of money, but you're also assuming the risk of potentially making not very much money at all. So the advantage of mutual funds is that they're managed by a professional, somebody who is educated and has learned over time how the market works. They're pretty liquid, which means that you can pull your money out of your mutual fund at any time. It's not locked away until you retire or anything like that. They are diversified, so they invest in lots of different types of stocks to mitigate risk, and it only requires a small minimum investment. So anybody with a little bit of savings can join a mutual fund. So those are advantages. There's different types of mutual funds. There's a growth fund, which is the idea of buying stocks that will increase over value. There's an income fund, where the investment goal is to produce current income in the form of interest or dividends. So growth, more long-term, income, more short-term. There's one that's a mix of both, which is the growth and income funds. There's money market funds that invest in safe liquid securities like treasury bills or treasury bonds that mature, meaning that they pay out in less than a year. There are global funds that purchase international stocks and US stocks. And then there's an index fund that matches the performance of a particular index by investing in companies included in that index. So let's say there's an S&P 500 mutual fund that will invest in, buy and sell stocks that are in that particular index. There's a risk and return pyramid here, and it kind of makes sense, but based on the different types of funds, at the top of the pyramid are higher risk, at the bottom of the pyramid are lower risk. But at the top are higher potential returns, at the bottom are lower potential returns. So money market funds are low risk, low return, pretty safe over long term. Income funds, a little bit more risky. Growth and income funds, a little bit more risky. And then growth funds, investing in particular stocks that are risky but have a high chance of, or have a high return if that risk pays off. There's also something called net asset value that tells you the market price for a share of a mutual fund. So it's the total value of a fund's investment portfolio minus its liabilities divided by the number of outstanding shares. So basically you take what is the current value of the portfolio, you subtract the liabilities, and then you divide it by the number of shares that exist, and that tells you kind of the market price of an individual share of a mutual fund. There are other options too for you. You could invest in real estate, where you buy land and any kind of buildings. Could be really good. It's a good way to combat inflation. Usually it increases in value over the years, higher than inflation does. So property values tend to increase over time at a pretty steady rate and a higher rate than inflation does. Real estate's it's one of the least liquid investments in terms of a disadvantage, because let's say you have money tied up in real estate. Let's say you paid $200,000 for a house, and then you want to turn around and sell it for $250,000, that's a $50,000 yield, which is great, but it's not like you can just turn around and sell it that day and have $250,000. It takes a long time. It can take months, it could take years to sell that property. So if all of your funds are tied up in real estate, then you can't access that money for a long time. Some real estate investments are speculative. Think about like flipping a house. You hope that you can get a certain amount of return if you buy a house at a low price, put some work into it, and then sell it at a high price, but you really don't know what you're going to get, and you can sometimes lose a lot of money in that process. With direct investments, you hold legal title of the property. So meaning you buy the land. So you can do that directly by buying vacant land, single family houses, rental properties, recreation retirement property. Those would all be real estate options. Other investment choices that are at your disposal are things like precious metals, things like gold and silver. Those are pretty reliable in terms of their value, although it does fluctuate over time. But the price of gold could go up or down depending on different factors. But if you buy gold at a particular price, it could shoot up in value, and then you could sell it and make a lot of money. Gems, same thing: diamonds, rubies, sapphires, emeralds. That's another option. And then there's collectibles for rare items like antiques, art, baseball cards, stamps, comic books. Might seem kind of silly, but there's potential that you could get a high return on those if you get good prices for them, and then you could turn around and sell them at an auction or something like that. The problem there is that it's high risk too, because sometimes collectibles can have their moment, and then everybody buys them, and then they don't end up being worth anything in the end. So that's it for this chapter. So looked at mutual funds, real estate, and other investment choices.